Hello, traders. I trust you are all well, and welcome to Live Trading Profits. Thank you for joining us this time. I trust this hour delayed start now suits a lot of you. Today has been a pretty busy day so far for me, quite interesting in many respects. A lot of opportunities we've had on I think virtually all of the markets. I'm presently just looking at seeing if I can jump into a trade. If it does set up for us, I want to look at Hang Seng 50 and talk about what we've had, the opportunities we've had so far. But I'm just casting my eye on my other screen so that the trade I'm looking at, if it sets up, we can jump in. I'm looking to jump into gold. Now, I want to look at Hang Seng 50. Sorry, seems like I'm all over the place, but I'm looking at a particular trade opportunity right now. I want to see if I can jump into gold. I'm not quite happy or certain that the attempts by the bulls to change the market are over. And the reason I'm saying that, the market has tried, bulls have tried once, twice, 3 times, which is a wedge pattern, to break above this earlier high of the day. I took a trade here earlier on, just off that reversal signal, one of the strategies that we trade. And then I had to get out as we bounced off the 20 EMA. Because that's a clear reversal, so a little bit of profit. So now I'm trying to find an opportunity to jump back into the market. So when you take in these early trades, remember, you're starting off by taking a reversal trade. And the reversal trade is lower probability trading. So you really just have to be a little bit strict with yourself. But then again, one of the things you must bear in mind when you take one of these trades, you're starting off with low risk, okay? And I'll talk about low risk later on. I don't jump into a reversal trade with full risk. I add in as we go along. So a little bit of patience with gold. If I was to take the trade here, remember I said you can always take a trade when you want to take a trade. The question is where do you put your stop? If I was to take it there, I'll have to look at a measured move of this wedge pattern that's low and put a stop up here. And that would be 45 pip stop. And when I look at my pricing, gold's either going 20 stop, 40 or 60. So, that could be reasonable to do. Alternatively, what I prefer to do is wait to see if off this wedge top, which is also a test of that previous high, we get a strong bear follow through. Then any form of lower high, I'll be happy to take that, whether the market comes up here to create a double top or just creates a lower high here, coming off the wedge top. And if we do that, then wherever the lower high is, I don't have to put a measured move stop. So my stop could be above just the earlier high or the high of the day, or this key level here, which is the low of 2021. So we broke through it a couple of days ago, and we pulled back to test it. So it's a pretty strong level of now its resistance. Okay, it just depends what we get from the market. So we'll come back and have a look at that. Okay, so I'm not taking that trade, but if we get just a bear follow through of any kind, strong bear candle, and then get a pullback, lower high of any kind, then happy to take that trade. Okay, so why did I take the earlier trade? I should have marked it for you guys, but let's just put it in. So the earlier trade was here. Some pretty interesting moves taking place. We'll look at them just now. The earlier trade was here. And the reason I took that trade, so that was the earlier high of the day. That one broke above the earlier high of the day. The bulls did not follow through. So whenever I see a breakout candle like that, and then I see a failure on the next candle, even though the market goes up later on, I consider that a failed breakout. Then I start to find opportunities to get in. This level here, 50% midpoint or range of yesterday, was a key level that we had. Now, when I set up my charts for each day, I'm always marking, you see, this green line, high of yesterday, low of yesterday. Then I just get my feed tool and connect the high and the low. And then I get a 50%, which is a midpoint range of the previous day. That's a key level. Of course, when the market is up, it's key level of resistance. When it comes back, it's key level of support. So I always have that marked. And then at the open of the day. The reason I mentioned that is the bulls then broke out again after this pause. Doji, so that was good for the, not a doji, so that was a bull candle, good for the bulls in terms of follow through. Then they had an opportunity to accelerate up, so very good for the bulls. So at this point, I'm thinking maybe the bulls will continue to push the market up further. But we had a doji, and then we had a test of the low of 2021. And a decent enough, I call this as a reversal signal candle. So while we had this bull move up here and that pause, bulls were weak, that was good enough for me to take a reversal trade with the hope that we might accelerate down and create some lower lows. But it failed here, so I was able to get out. Small profit actually, but I got out. So that's why at this point, I'm very keen to just wait a little bit. You know, I see the wedge, I see the 3 attempts, I see the double top, I see the lower high, all of that stuff. But I'd rather wait. I just want to see the bears demonstrating some strength. So if I can see the bears in this candle, the follow-through candle, just closing beneath the 20 EMA, that would be perfect. And then I look for a lower high to trade. So that's gold. Just look at it on the daily very quickly. Put some things here which I must just make sure they're only showing on the 5 minutes, and I can just talk about. Okay, that's fine. That should also be just only 5 minutes. What else people put that in? Okay, let's see if we can see things clearly on the daily. Yep. Now, this is what's happening on the daily. Very interesting. You know, we've been talking about the market crashing continually, but where we at with gold is very interesting. We had this, let's turn that a bit. This light blue line here was the low of 2022, which is what we got in July. Then we had, of course, the low of 2021 that I spoke about. And more interestingly, we have been in a bear channel. So that's a spike and channel pattern, which is fantastic as far as getting clarity in terms of our market, in terms of the structure. So where we are now, it's a legitimate place for the bulls to turn the market, because bulls would argue a good bear candle, failed breakout beneath the low of 2021. We are at the bottom of the channel. Of course, when you grow the channel, you cannot use that particular tool, connect the lower highs, and then you just pin this general line just here. So I pinned it to that low. So I leave it there, and I can see that on my daily, my 5 minute, I can see the market trying to break out of that. So as far as the bulls are concerned, they're saying, well, this is where we can legitimately push the market up. Can probably only go far initially as a descending 10 EMA, which we use as an indicator of strength. They want to test that, and if they can break above that, they have to get over the 20 EMA. Look what happened here. We tested the 10 EMA, failed to go over 20. But the ultimate objective will be to get to this channel line. So, the bulls can continue to buy until they get there. And of course, the bulls would love to break above that and just keep going up. But, to break out of a channel is extremely difficult without strength, without momentum. So that's kind of where we're at right now. If today ends up as a bull candle, it's a breakout mode pattern inside candle. This candle's inside, that's an inside candle, and this one's inside that, inside pattern. Inside pattern is a strong breakout mode, which basically because market will not just continue narrowing down to a line. So there will be a breakout of sorts, favoring the direction of the candle, the last candle. So the bulls want to break out above that. So if you trade in on the daily time frame, of course, you wait for your daily candles to close, and you're going to be very interested in where the market closes as far as the low of 2021 is concerned. You don't want the market just to test and close there, because you've got to ask yourself a question. If the bulls are strong, why can't they give us even a small close above the low of 2021? So if you take a trade, your stop has to be down here. This is on the daily. And of course, if you see a setup and let's say today ends somewhere down here. If you're taking a daily trade, your stop has to be above that level. That's what way you put your stop. Okay, so we wait. We better wait for a little bit more information. Now, the other thing I want to say, you can legitimately take a trade. So you could take a trade if you wanted, and if you're going away, so we can just leave it there. And I use white stops, like no problem taking trades when I think the setup is right. And using a white stop is a stop that's just above the level. It's like a measure move stop. So you could just take a trade there and go away and know that if you get a pullback, which you're likely to get, there is a lower probability of you being stopped out by the measured move. So that's measured move. So you always want to go just a little bit above the measured move. So you could do that. Or like we're doing now, we're choosing not to take a trade for measured move stop. We're going to wait to see if it accelerates down, get a bear candle on the pullback, and we take a trade to put a stop there. Okay, so I'm just going to do that. And then let's go to Hang Seng 50. Hang Seng 50. So here's an example of a white stop. Okay, I put the stop up there when I took the trade because I looked at all the technical levels. So I looked at this and I said, I want to take a trade here, but I'm not going to put a stop here because market can come back and test that level, or come back and test that level. So the furthest conservative technical level I put my stop at is there. Could you put it higher if you're going away, and you want to leave the trades in 4 hours, and your assessment is the market is going to go down further, then yes, by all means, trade size it. So I have a couple of trade sizes on my Hang Seng 50. So more conservatives like $50, and then I can always go $100 stop in terms of where the stop goes. Then I'll just leave it. If we get above here, and fine. If we get above here, if you get above here, I get stopped out. And I'm still fine. You have to be fine with where you've put your stop. So let's just talk about what took place with Hang Seng 50 from the open. I think it illustrates a few things. So first candle of the day, bull candle. We close the open there, so nice. Second candle, bear candle, outside candle. Whenever I see an outside candle, I'm starting to think, hey, the market is going to break out of this because an outside candle is trading range. Then we have an attempt by the bears by the bulls to break out, and it fails. So at this particular point, I'll be keen to see, are the bulls strong enough? There's been tails here, which means the market went down, went up, went down, went up, went down, went up. So every time the market went down, the bulls were strong enough to come back. So if they're strong, 3 candles into the open, then they must give us a break above this high. Then we can look for a pullback of sorts and trade. So he's sitting there anxiously, got everything trade sized, but then voila, nothing happens. Okay, they fail to break out above that. Instead, we have a huge bear candle, breakout candle. When you have a breakout candle, I always want to wait for confirmation. So looking at that, kind of hoping get market closing on its low, and it didn't. So then you got to wait for a little bit more information. Breakout, failed breakout because of the tail. The only way, or the only strategy we have to trade this breakout is if the next candle, it's an inside candle, but if it closes on here, it's low, which means it has become a high test candle. Then happy to put a trade to see if we get a breakout below that pullback. Okay, so I'm not trading that pullback. So if that had been a low down here, happy to do that. Excuse me. And stop will have to be up here. There's no other way to put your stop. You could always put a 50% pullback stop. It's another legitimate place to put a stop. So you look at the actual bodies of the breakout. So your 50% is there. So if we'd had that candle forming the way that we wanted it, bear candle, then you could, buy the break of that candle, put it there. That's a more aggressive stop. If you want to be conservative and not have to worry about being stopped out often, you just put your stop at the correct place. Okay. We'll talk about these quite a lot more. In any case, so no opportunity here. Then, we inside candle, see if the bulls are strong, inside candle, bear candle, but, we can't trade that. We want to wait for an opportunity to get a test of key levels and get to the EMA. The first opportunity we get is this candle here. Now, that candle is tradable. And there's 2 ways you can trade it. You can put a stop order beneath the candle, or because you've seen the failed test and it's a bear body, and I do that quite often, sell beneath the body. So you could sell beneath the body right there. Technically, I just call them the same trade, whether you take it there or take it there. When you take in there, of course, it's a much higher risk trade. And where you're going to put your stop is going to be here. That's a conservative, an aggressive stop. Conservative stop, just look at the nearest technical level up there. Okay, and that's for if you're taking this particular trade here. If you're taking the break beneath the candle, you can legitimately put your stop here. So 2 places where you can put your stop. So you put your stop there. If you trade in the break of the low of the candle, you can put your stop there. If you're taking that trade beneath the body, so it's a little bit more aggressive entry, then you need a stop. Technical level is the highest, nearest technical level. Okay, so as the more you trade, you get to know your risk profile. You get to understand where you're comfortable to take trades and put your stops. Let's just talk about briefly capital allocation. Whenever I'm taking trades, like especially these reversal trades, we've got reversal trades. If the market goes away, pulls back and continues to go down, then we are in a trend. Trend trade is different kind of trade. There's a higher probability. If you take a stop order trend trade, that things are going to go your way. When you're taking a reversal trade, you need a wide stop and be able to just sit through the pullbacks and anticipate and see what you might get. So what I always do with my reversal trades, I'm always trading 0.25% off the risk. Okay, 0.25% of my capital. I don't go above that. So the reason I do that, it's a reversal trade. I know chances are there's a higher probability of the market reversing, maybe stopping me out before it starts to go back in my direction again. So I don't want to put the full risk in, put in my full 1%, get stopped out, then it sets up again, then I better think, should I now take the trade again? I'm already down 1%. You don't want to do that. Well, I don't want to do that. Then I tend not to take trades and I sit there trying to work out all my risk factors. And by the time I say, okay, it's time to trade, it's moved. Only reason being I put in too much risk at the beginning. So when I'm taking my trades, I'm always putting 0.25%. If I get stopped out, fine, happy to go in again. No problem. I'm prepared to sit through any pullback because it's only 0.25%. So, for example, this was a reversal trade that I've taken here because market is going up. I'm hoping that the lower high holds and we accept down. So I'm not going to put 1% here. I put 0.25% and I've got the risk up there. Just let it be, not stress. Okay, so you take that trade and then you get rewarded with that. Now, when that takes place, I'm thinking, hang on a second, if we break beneath this, if the bears are strong, following up from what you've had and what you've had, then the bears will continue to sell, the market will continue to go down, even if it goes sideways. So when you get that and the market is down, it's like, hey, good for the bears. And then on the close, you always have to wait for the close. When the close pulls back, and that's already a problem for the bears because I'm hoping for a bear breakout. Get a breakout candle, big tail on the bottom, and then the market reverses. So when you get that kind of price action, again, remember there's two ways that you trade. Either you are in the market actively trading and managing your trades, or you take your trades and you go away, you let the market do whatever the market is doing. I like to actively take my trades, especially in that phase, like I'm trading the open. I want to be there and see what's going to take place. If you're not going to be there and you say, I have to go somewhere, I can call it out, then tighten your stop to a technical level, okay, and then go and come back and see what happens. But when I see this kind of thing, I say, not happy with this, happy to close the trade. As this candle closes, happy to close the trade. Okay, so again, a bit of profit. I guess if you had set a one-to-one, let's just see, according to one-to-one. If you had set a one-to-one, yeah. So if you've taken that trade and say, okay, I'm just happy to get one-to-one, and my measured move says one-to-one is at that low, put your take profit in, get there, bank your one-to-one, that is perfectly fine as well. And You would have banked more, of course, than someone, like me trying to manage my trades because the market is reversing. I'm trying to manage the trades. Get out, break even. Then I don't go away because I want to see what other information I get. Bulls, dodgy. That again is not good for the bulls. Follow through. Then we have a huge bull candle testing the low of yesterday, testing the breakout point, that point, and it fails. The tail of the top is a failed breakout. Bulls were trying to break out above all of this and just keep on going, but that fails. That fails immediately. So market went up, came back. So the bulls controlled the candle all the way up. That tail indicates that the bears controlled the tail back into the close. Then I wait for follow through and I saw that. I said, oh, fantastic. Happy to go in again. So at that stage, you can go in again. Well, I'll put the stop up because we had a technical level there. It's a lower high double bottom, double top, sorry. So that is a lower high double top. I'll turn this up later when we're done. So at that point, that's the correct place to put your stop when you're taking that trade. It's above its technical level, which is lower high double top, which also beautifully is just above this level, which is the low of yesterday. So and as you're going along, you're getting all these trades coming up, taking them, and your kitty is slowly building up. So again, you can take the break of the trade, of the candle, or if you're fast enough, you can take beneath that. But for both levels, there is your stop. So again, seeing that, watching that, and I'm thinking to myself, okay, lower high double top, decent enough reversal. The bears maybe can take control of the market at this stage. Okay, so there is a trade, we get to here, and then we get a pullback, which is not what I was hoping. I was hoping that, we continue to go sideways, but get a pullback test of the 10 EMA. So we have a strong, trend unfolding right here. So test of the EMA. I'm not going to, add any more to the trade here. So I'm getting pretty much down to where I want to go. And also it's a bull candle head. This candle gone up, come back. And if it was a bear candle, okay, and if it was not an outside candle, you could add on to your trade here. But, when you do that, your stop still has to be up here. So you really got to weigh out whether you want to do that or you want to wait. Follow through, and I'm hoping that the base has break beneath here and we keep going down. But unfortunately, we don't get it. Failed breakout, higher low, and then inside candle is a decent enough candle for the bulls to get in. Again, you have a choice. You can exit that trade or you can wait to see what happens. I got out of that trade, as that candle went above that because this inside pattern is a breakout mode. So again, a little bit of profit and we're out of that. Now, if you were fast, and I'm typically not that fast. If you were fast and you saw that and you kind of saw that failed breakout, that dodgy candle forming, you could say to yourself, hang on a second, the bears are not strong enough. I'm going to get out of my trade immediately in case I get a reversal. Remember, I stayed in my trade. So if you did that, then you saw that inside candle and you're not trying to manage that trade, you could go in and buy that. That would be a legitimate trade to buy. So I'm going to put it in just so we can see, but I did not take that trade. I was busy managing my shorts. So you could take that trade. and you're buying an inside pattern. It's inside this outside candle. So what you need is a measurement stop. So the stop would be here. So that's a legitimate trade that you could take. It's also good to see the other side of it. So, you know, we all see things differently. You might be seeing, not necessarily seeing things different. You might be waiting to say, I'm going to wait to go long because, so for example, you know, you might have seen all of this and said, oh, the bulls are strong, bulls are strong. You took that trade and you got out at break even, but then you say, okay, I'm not going to take any more shorts. I'm just going to wait and see if I get an opportunity to go long. So you might not have been distracted by trying to manage, you know, your shorts. So that's a legitimate one. If you're in your shorts and you're pretty fast to make your decisions and not want to hold your trades, then get out and jump in. What I don't do, if I've missed that opportunity, like I was in that short trade, I've missed the opportunity, and then I see the setup here or there, I'm not going to jump in. Okay, I got out with this candle, you know, got to kind of reflect, to get some coffee and sit and think before I jump in. But I don't like to then follow the trades. I like to take my reversal trades as early as possible. However, if you take in that trade and the market goes your way and you get a reversal candle like that, if you want to add into your trades, or if you're still thinking long, that's a good place to take a trade. Your stop is now at a different level. Because you're now taking the second trade, you're almost in that's like a breakout pullback. So getting into a trend. So when you take that, you don't put your stop here. Your stop goes to this low, but then you look to the left and the nearer technical level is that. So now you can put your stop here for that trade. Let's just put it in before we change color coding. Now, there's nothing wrong with taking both bulls and bears trades if you're fast enough. I mean, and I've done it before, but I find that if I do that, I'm looking at several charts, I'm bound to start making mistakes at some point. So I'd rather just let something go, reflect, think, and then come back and say, okay, where are the next opportunities? So if you took all of that all through the pullback, bull breakouts, bull follow through, and now at this stage, if you're taking the trade, you're hoping the bulls are strong, then it's just accelerate. That's what you want before. You want the bulls just to, let's just push this thing and keep going. But then you get that failure. Okay, so bulls went up, tested, and they failed. This is almost the same as this pattern. Went up, failed. Went up, failed. So you see a decent enough bear inside candle. If you're holding on to your longs, and you see that this is a good place to get out of the trades. As the market starts to sell, get out of the trades. Because a higher probability than not that the market might go sideways or might just accelerate down, and then you give away all your profits. It went up beautifully up here. How would you take advantage of that? If you want to take advantage of that and say some bulls are strong, pull back, they're going to test the 10 EMA, they might just be a little bit more. I'm not going to take my profits earlier down here. I want to take my profits at this level and see maybe we might just get a little bit more. That is perfectly fine to do. However, what you then need to do is manage your stops correctly. Okay. This is not a signal for us to trade bear candle, but if it was a bull candle and you're taking an entry above there, your stop would be here. So you see all of that, and then the market gets up to here and goes up and saying, hey, I want to hold on to a trade, just in case there's a little bit more. You have to move your stop up to this level. First, when you get the breakout, that's where your stop comes. This breakout, when you get the follow through, can tighten your stop up. That's the nearest technical level. Then that's where, obviously I'm going to get out of the trade, but you deciding you're going to stay in the trade. I'm just looking at, gold is gone while we're talking. Anyway, don't worry about it. We'll look at it just now. So that's where I'll be getting off. And instead of closing the trade, holding the trade here, and just hoping that the market turns. If it gets beneath here and starts to sell off, you're still in a bit of profit, get out at break even. But then here, in this case, you got rewarded, and you still want to wait and see. You can move your stop up to here. And if you got the patience to wait, you wait. But here is the problem, because these are all levels of resistance. So if you saw that and you got up and get some coffee and say, man, look just how far the market has moved, I'm super happy with it. You come back and it's all gone. What I'm trying to point out, take your profits. If you're taking your profits at key levels, if you're going to manage it, then hold it. When it starts to turn, you must get out of it. Okay. So I'm not in any trades at this particular stage, based on the way I traded, and I see that particular opportunity. I say, oh, fantastic. Here we are. The bears are back. Now we have another, lower high double top. We'll have a look at gold shortly. I mean, it's kind of going a little bit away, but that's perfectly fine. We'll talk about how to jump in, if you want to stay in the market. So I saw that lower high, but I'm not jumping in as yet. I'm hoping to get another lower high or a double top, and voila, we get this. As this was forming, I'm saying, man, the bulls are strong. They're going to close above the high of the day, and then we're just going to keep going up. But when they failed to close above the high of the day, I realized bulls are not as strong. So no need for me to look to jump into any trades, short breakout. I didn't know this was going to happen. I thought maybe get a double top, lower high, then we have to worry about this level of now support. But bear strong enough to come back. So now looking for opportunities in the market, breakout, to get a pullback. So that wasn't comfortable with that because of this whole structure. And then when the bulls failed to break out and got this reversal, this is a gift. Sometimes you sit through these markets and nothing happens, but sometimes you get a gift. When you see a gift, it doesn't mean it's going to go your way. It just means take the gift. Okay, so as good as they come, and then if they're the only thing that you'd have to worry about is your stop. But by now you kind of know we put our stop at technical levels. So you risk it, not risk it, you price it, risk price it. There's your stop just above there. Now, okay, no worry about it. Clean this up just now. That should be great. Just a little note here. So even though I banked some profits along the way, because I'm still taking a reversal trade, okay, I'm still taking a reversal trade, I'm still going in at 0.25%. That's a non-negotiable rule. Still going in at 0.25% because it's the first reversal trade. 0.25% going your way. If we're taking more trades here, and these are 1-to-1, then I go to 0.5%. I was 1-to-1, go to 1%, and just, that's the ultimate goal, to get a beautiful trend, to execute it as perfectly as you can, and go from 1/4 to 1/2 to 1, as long as each is at 1-to-1, just keep building your positions. But here we're starting again. Now, of course, what am I hoping for? Huge bear breakout. Then we get here. I don't know if when you look at the charts, you'll notice. I mean, this was a perfect double top. I mean, the low of this is 462.39. The low of this candle. The low of this candle, 462.39. I looked at that and I said, man, perfect double bottom. Okay, so the gift is probably not going to go far. So I got that and I got out here. because I'm thinking from the double bottom, the market is going to accelerate up. Okay, but guess what happened? Go to the 10 EMA and it failed. And I'm still thinking, well, double bottom, the market is going to fail at this perfect double bottom. But as well, there was a little bit more, so I didn't benefit from all of that. Then, if you're watching this candle form, at some point, it was also a perfect double bottom of that. And I'm thinking, man, the bulls are very strong in the market where they're creating perfect double bottoms. The bears are trying to break out and failing. So this for me was, well, this is a perfect opportunity for the market to accelerate up. So based on that double bottom, a failed breakout beneath it, based on the market trying to go down once, twice, 3 times, which position, based on this tail, said, I'm going to take that trade. So I took the trade. For the guys who sit through Wednesdays at the market, sometimes we don't get days like this where, I mean, it's not trending as much as we wanted to, but there's a lot of opportunities. In these forms, we're taking. So I took that trade. I'm not necessarily sure where I took it. You can take the break of that candle, perfectly legitimate. And the stop is here. Okay, so you take the break of that candle. I took it on its close, which is almost like that particular trade. So I'm just buying on the break of the body. You don't have to do that. I mean, we'll talk about that a lot more, just a little bit more advanced ways to take a trade. So what you want to be doing at this stage is taking the break of candles. So you could take that. Stop is the same. And I'm thinking, hey, George, today is a day of gifts. Off here, the market is just going to accelerate up. And man, I'm watching this. I see this candle. I said, good, bulls are going to go up to here. On its closure, failed. And I'm like, hey, guys, I mean, look at all this bullish strength, perfect double bottoms. Was it perfect at some point? Failed. Then it fails. And I thought, let me hold on a little bit. Went up again, it failed, and it came back. And I closed the trade at a little bit of a loss. So, I didn't get what I expected, but managed it, got out a little bit of a loss. And then I decided to leave it. And I came back and I thought, okay, let's wait. And where are we with time? Oh, a couple of minutes to go. Couple of other trade opportunities. I did not take this long here, and the reason I didn't take that long, it was just at the open of that second session. I decided not to do that. Then I took this short, and you can see where my stop is. So just a minute, let me just go to gold very quickly. Gold. Oh, okay. It looked like it had gone on my other screen. That's not bad. So we had the follow-up by the bears. That's good. So this wedge is what we're talking about. Went up almost a perfect double top. Bears are strong. So this is still an opportunity if you want to look for it. We're not going to sell here. We want a lower high somewhere within here. Okay. That's lower high. Let's have a quick zip in 30 seconds. Some of the other trades that I'm in, I am in S&P 500. I'm going to have to pull the stop down when we're done, a little bit lower. That's I took the trade here. So in that trade, I am in 9 UK 100. No. Okay, so UK 100, there's an opportunity there. I think I'm going to take that trade. I'll have to put my stop somewhere up there. That's one that I'm going to trade. And then the last one is German 30. Okay, I'm in German 30. Again, I think I'll need to put the stop down. Stop is up here. I took the trade here with a measurement of stop. So now I'm going to tighten the stops as soon as we're done. Guys, we are out of time. Thank you very much. Let me see, there's a question here. Moving average setting. So the thick one is a 10 EMA, which I use to indicate the strength of a trend. So instead of doing trend lines, I use that. And then the lighter one is a 20 EMA. Okay, guys. Thank you, Marlon. Thank you guys, and thank you guys for coming on board. For those who are joining me in the trading the open course on Sunday, I really look forward to being with you guys. And obviously, I always give more than is advertised. If you haven't signed up as yet, get hold of the office and join us in that show. All right, guys, take care. Cheers. All the best. Bye.